This lesson details the necessary steps required to properly close the accounting records. In accounting, companies maintain financial records for one period or a fiscal year, which is equivalent to 12 months. At the end of each fiscal year, companies close all temporary accounts in order for the company to start the new fiscal year with zero balances. There are two main categories of accounts, permanent and temporary. Permanent or real accounts have balances that carry forward year over year. These accounts are not closed at the end of the period. The balance in the account is not related to only one period or fiscal year. Instead, the balance in the account carries over from one period to another. All balance sheet accounts are permanent accounts. Cash is a great example of a permanent account. If a company has $20,000 in their cash account at the end of 2015, that balance will carry forward to 2016. The account does not zero out. Instead, the cash is carried forward to be used in future periods. Temporary or nominal accounts are accounts that report amounts for a specific period of time or a fiscal year, and the balances do not carry forward year over year. All income statement accounts and dividend accounts are temporary accounts. Revenue is unlike cash because revenue reflects the amount of money earned by a company for a specific period of time. At the end of that period, the balance needs to be closed to ensure the starting balance for the new period is zero. To ensure companies report financial information for only one period or fiscal year, temporary accounts should have zero balances at the beginning of the next period or year. To achieve this, temporary account balances are transferred to permanent accounts at the end of the accounting period through journal entries. The journal entries that transfer these balances are called closing entries. The process of transferring these balances is called the closing process and is often referred to as closing the books. After the closing entries are posted, all of the temporary accounts should have zero balances. There are 4 steps to the closing process. The first step is to close or transfer all revenue account balances to the income summary account. The income summary account is a temporary account that is only used during the closing process. It is frequently referred to as a clearing account. The second step is to close or transfer all expense account balances to the income summary account. The third step is to close or transfer the balance in the income summary account to retained earnings. The fourth step is to close or transfer the balance in the dividend account to retained earnings. Let's review the flow chart that details the closing process for Net Solutions and walk through each step. The first step in the closing process is to transfer or close the revenue accounts to income summary. Per the T accounts in the flow chart, Net Solutions has 2 revenue accounts, fees earned and rent revenue. At the end of the period, fees earned had a credit balance of $16,840. To close these accounts, we need to create a journal entry to zero out the account by transferring the balance to income summary. The entry to close fees earned is to debit fees earned $16,840 and credit income summary by $16,840. This will zero out the credit balance in the account and transfer the balance to income summary. The second step is to transfer or close all of the expense accounts to income summary. Per the T accounts in the flow chart, there are 7 expense accounts that need to be closed. Let's review wage expense. According to the T account for wage expense, there was a debit balance of $4,525. The entry to close wage expense is to credit wage expense $4,525 and debit income summary $4,525. The credit to wage expense will zero out the debit balance in the wage expense account and transfer the balance to income summary. After all revenues and expenses are closed and transferred to income summary, there will be a balance in the income summary account. This balance is actually the net income or net loss for the company because the revenues and expenses have both been transferred to income summary. The third step is to close or transfer the balance in the income summary account to the retained earnings account. Per the flow chart, Income Summary for Net Solutions has a debit of $9,855 and a credit of $16,960. Since the credits are higher than the debits by $7,105, we will need to debit this account in order to zero out the balance. The entry to close Income Summary is to debit Income Summary $7,105 and credit retained earnings $7,105. This entry will close Income Summary and transfer net income to retained earnings. The fourth and final step is to close the dividend account to retained earnings. Based on the flow chart, the dividend account has a debit balance of $4,000. The entry to close dividends is to credit the dividend account $4,000 and debit retained earnings by $4,000. This entry will zero out dividends and transfer the balance to retained earnings. The next exhibit details each closing journal entry that's required in order to close the temporary accounts. Please review each transaction and the journal entries to ensure you fully understand the process. The final step in the accounting cycle is generating a post-close trial balance. The post-close trial balance is prepared after the closing entries are posted. The purpose of the trial balance is to verify that the ledger is in balance and all temporary accounts have zero balances for the start of the new accounting period. This concludes this lesson.